For generations, the American dream was simple: work hard, save money, buy a home, and build a better life than your parents. Today, that dream feels impossible for millions of Americans. Instead of asking, what house should I buy? Many young people are asking, will I ever be able to buy home at all? So how did the richest country in the world made home ownership so difficult? The answer isn't one bad decision. It's decades of government policies, low interest rates, and Wall Street turning homes into investments. This is the story of how America priced an entire generation out of the American dream. For most of the 20th century, buying a home was difficult but achievable. In 1972, the average home cost was about three times the average household income. Today, the median home sells for over 400,000, while the median household earns only about 80,000 a year. That's more than six times annual income. Housing has become so expensive that the average buyer spends over 40% of their income on housing. Renters aren't doing much better as well. More than half of all renters spend over 30% of their income on rent. One in four spend more than 50%. The consequences are everywhere. Young adults are living with their parents longer than any generation in decades, and millions have accepted that they may never own a home and will rent for life. The American dream didn't disappear overnight. It slowly drifted out of reach. But this didn't happen because of one bad decision. America's housing crisis was built over decades, one decision at a time. So, how did we get here? Normally, when prices go up, companies make more of something. If oil becomes expensive, companies drill more oils. If food prices rise, farmers grow more crops. Housing should work the same way. Higher prices should encourage builders to build more homes. But that's not what's happening. The turning point was the 2008 financial crisis. Before the crash, builders started construction on more than 2 million homes a year. Just 4 years later, that number had fallen to only half a million, a drop of almost 75%. Thousands of construction companies went bankrupt, many workers left the industry, and banks became much more careful about lending money for new housing projects. The economy eventually recovered and people wanted to buy homes again, but the home building never recovered at the same pace. Between 2010 and 2019, America built fewer homes than in any decade since the 1960s. Every year, the country fell further behind. By 2018, Freddie Mac estimated that US was short of 2.5 million homes. Just 2 years later, that shortage had grown to 3.8 million homes. The problem was even worse in cities with good jobs and strong economies, where demand was already high. Builders also changed what they built. In 1980s, nearly 40% of new homes were affordable starter homes for first-time buyers. Today, that number is only 7%. Instead of building smaller, cheaper homes, developers focused on larger houses that made more money. America didn't just stop building enough homes, it also stopped building the kinds of homes the first-time buyers could actually afford. So why weren't builders building more homes when demand was so high? The answer wasn't a lack of buyers, it was that in many places building new homes had become incredibly difficult. By this point, America already had a housing shortage. The obvious solution was simple: build more homes. Instead, many local governments spent decades making that harder. The biggest reason was zoning laws. These rules decide what can be built, where it can be built, how tall buildings can be, and even how many parking spaces they need. On paper, these rules sound reasonable. In reality, they often prevent enough homes from being built. Take the San Francisco Bay Area. About 82% of residential land is reserved for single-family homes. That means duplexes, triplexes, and small apartment buildings are illegal across most neighborhoods. Many cities also require minimum lot sizes, meaning every home must sit on a large piece of land. Others limit building heights or force developers to build large parking lots. For example, in Cupertino, California, many apartment projects must provide two parking spaces for every apartment. A 100-unit apartment building may need room for 200 parking spaces. That takes up valuable land, increases construction costs, and leaves less space for housing. Some cities have even stricter rules. In Atherton, California, the minimum lot size is 1 acre or more than 43,000 square feet. Affordable starter homes were never going to build under rules like these. Many of these policies were introduced to reduce traffic, protect neighborhoods, or preserve property values, but they also made it much harder to build affordable housing in the places where people wanted to live most. At the same time, America was limiting the supply of homes. Another government institution was about to increase the demand like never before. That institution was Federal Reserve. By now, America already had a housing shortage. There weren't enough homes, especially in the places where people wanted to live. Then the Federal Reserve stepped in. After 2008 financial crisis, Fed cut interest rate to nearly zero to help the economy recover. The goal was simple: make borrowing cheaper so that people and businesses would spend more money. Housing wasn't the target, but it became one of the biggest winners. Mortgage rates kept falling. In the early 80s, a typical 30-year mortgage had an interest rate of almost 19%. By 2021, it had dropped to just 2.6%, the lowest rate ever recorded. At first, that sounded like a great news. Lower interest rates means lower monthly payments. But here's the problem. Imagine you can afford a monthly mortgage payment of $2,000. At a 7% interest, you could borrow about $300,000. But if you lower the rate to 3% and suddenly you can borrow almost $500,000. So you didn't become richer, your house didn't become cheaper. Banks simply allowed millions of people to borrow much more money. When millions of buyers can suddenly afford bigger loans, they all start bidding higher. And when there aren't enough homes to begin with, prices rise even faster. Then after COVID-19, remote work became common and millions of Americans wanted larger homes. But the country was already short about 3.8 million homes and builders couldn't keep up. The result was predictable. Between 2020 and 2022, US home prices increased by about 40%, one of the fastest jump in history. When inflation surged, Federal Reserve raised interest rates again. Mortgage rates climbed about 7% and many people expected home prices to fall. Instead, another problem appeared. Millions of homeowners had mortgages with interest rates below 3%, so selling their home meant buying another one with a much higher rate, which could double their monthly payment. So they stayed where they were. Economists call this the lock-in effect. Fewer people sold their homes, fewer homes came onto the market, and prices stayed high. America now had the perfect recipe for housing crisis: too few homes, record demand, buyers with cheap money chasing limited supply. When all this was happening, Wall Street was paying close attention. For most American history, Wall Street had little interest in single-family homes. Office buildings, hotels, and shopping malls were much easier to manage. That changed after 2008 financial crisis. Millions of Americans lost their homes through foreclosure. Banks suddenly owned thousands of cheap homes they wanted to sell. Wall Street saw the opportunity. In 2012, private equity giant Blackstone launched Invitation Homes and began buying thousands of single-family homes. Other companies, including American Homes for Rent, Progress Residential, and so on, quickly followed. Today, institutional investors own hundreds of thousands of single-family homes across United States. Nationally, that's still a small share of all homes, but housing isn't one national market. It's thousands of local markets. Between 2018 and 2024, institutional investors bought more than 16,000 homes in Phoenix, another 16,000 in Dallas, and over 8,000 homes in Jacksonville, and another 8,000 in Nashville. In some neighborhoods, they became some of the biggest buyers. That made it even harder for ordinary families to compete. Imagine you have spent years saving for a down payment, you find the perfect house, apply for a mortgage, schedule an inspection, and wait for the bank to approve the loan. Then another buyer makes a cash offer and closes the deal in just 5 days. That buyer is often a large investment company with billions of dollars to spend. These companies don't need mortgage or inspections, so they can move much faster than average family. Buying the home was only the beginning. Once those houses became rentals, they generated income every month. As rents continued to rise, so did the profits. A study by Federal Reserve Bank of Philadelphia found that institutional investors increased rents about 60% faster than average after buying homes. Research also shows that neighborhoods with more investor owned homes often saw faster rent growth. To be fair, Wall Street didn't create America's housing shortage. The shortage already existed because of years of underbuilding and restrictive policies. But Wall Street saw an opportunity and took advantage of it. Homes were no longer just places to live, they had become financial assets that generated income and increased in value every year. The American dream wasn't just becoming more expensive, it was becoming an investment. By now, it might seem like Wall Street is the main problem. But the truth is, America's housing system rewards almost everyone who already owns a home. For most homeowners, their house is their biggest investment. According to the Federal Reserve, the median homeowner has a net worth of over 400,000, while the median renter has less than 11,000, almost a 40x difference. Higher home prices also benefit local governments through higher property taxes, banks through larger mortgages, developers through more profitable luxury homes, and Wall Street through higher rents and rising property values. So as you can see, everyone involved in this whole process benefit from higher prices except the buyers. The people who lose are the first time buyers, teachers, nurses, firefighters, construction workers, and young families. That's why the housing crisis is so difficult to solve. Lower home prices would help millions of buyers, but they could also reduce the wealth of millions of existing homeowners. America didn't just create a housing shortage, it created a system where expensive homes benefit almost everyone already inside it. The good news is that America knows how to fix the problem. Most economists agree that the country simply needs to build millions of homes, especially affordable apartments, townhouses, and starter homes in high demand areas. Some places have already started. Minneapolis ended single family zoning citywide, while Oregon and California made it easier to build duplexes and fourplexes. America didn't run out of land, builders, or money. It made decisions that limited housing while increasing demand. For decades, homes have served two purposes: a place to live and an investment that keeps rising in value. Today, those goals are in conflict. A home can't become more expensive every year while also staying affordable for the next generation. The solutions are known. The real question is whether politicians are willing to make the changes needed to bring the American dream back.